Today, we will talk about delta hedging. Delta hedging is an options trading strategy that aims to reduce the directional risk associated with price movements in the underlying asset. The approach uses options to offset the risk to either a single other option holding or an entire portfolio of holdings. The investor tries to reach a delta-neutral state and not have a directional bias on the hedge. The most basic type of delta hedging involves an investor who buys or sells options and then offsets the delta risk by buying or selling an equivalent amount of stock or exchange-traded fund shares. Investors may want to offset their risk of moving in the option or the underlying stock by using delta hedging strategies. An options position could be hedged with options exhibiting a delta that is opposite to that of the current options holding to maintain a delta-neutral position. A delta-neutral position is one in which the overall delta is zero, which minimizes the option's price movements in relation to the underlying asset. The value of an option is measured by the amount of its premium, which is the fee paid for buying the contract. By holding the option, the investor or trader can exercise their rights to buy or sell 100 shares of the underlying asset but are not required to perform this action if it is not profitable to them. The price they will buy or sell at is known as the strike price and is set at the time of purchase. An options position could also be delta hedged using shares of the underlying stock. One share of the underlying stock has a delta of 1 as the stock's value changes by $1. For example, assume an investor is long one call option on a stock with a delta of 0.75, or 75 since options have a multiplier of 100. Here are 5 key takeaways. 1. Delta hedging is an option strategy that seeks to be directionally neutral by establishing offsetting long and short positions in the same underlying. 2. By reducing directional risk, delta hedging can isolate volatility changes for an options trader. 3. An options position could also be delta hedged using shares of the underlying stock. 4. Delta hedging benefits traders when they anticipate a strong move in the underlying stock but does require traders to constantly watch and adjust the positions involved. 5. Options position could be hedged with options that have a delta that is opposite to that of the current options holding to maintain a delta-neutral position. Hope this would help. Thanks for watching.